Hi, we're now on Module 3, Trend Concepts. Were you able to do your own research? Okay then, let us compare notes. Welcome to the Responsible Traders POV. These are my notes, my own additional research and studies on the topic that I posted, and my personal observations and opinions that I am sharing with you to further enhance our knowledge and understanding. Some of these were previously posted on the Responsible Trader thread of Stock Market Pilipinas. This is the latest version of previous posts I made. Some of these, plus further explanations and discussions, will be appearing in my forthcoming book, The Responsible Trader. Before we go to Module 3, let us do some quick review. Collectively, what do you call these candlesticks? What do they signify? Can you name them? If you answered doji, you're right. A doji is a candlestick with no real body. Doji signify indecision on the part of the buyers and the sellers. The first one is a cross doji. The next one is a dragonfly doji. The third one is a gravestone doji. And the last one is a four price doji. What do you call these candlesticks? What do they signify? If you answered Borobusu, you're right. This one is a green Marubusu. It is bullish. This one is a red Marubusu. It is bearish. Japanese candlesticks with real body and without or burial wicks or shadows are called Marubusu. They signify strong sentiments, strong bullish or strong bearish sentiments. Is this an arithmetic or a logarithmic price scale? If you answered logarithmic price scale, you're right. A logarithmic price scale is plotted so that the prices in the scale are not positioned equidistantly. Instead, the scale is plotted in such a way that two equal percent changes are plotted as the same vertical distance on the scale. Let us now go to Module 3, Trend Concepts. A trend is the core of all of technical analysis. Knowing the trend gives you an edge in your trading. Most of the time you want to be trading in the direction of the trend. I have often heard and read the trend is your friend until it ends, or the trend is your friend until it bends. Please allow me to make a different statement. The trend is my friend forever, or to make a better rhyming statement, the trend is my friend until the end. Before the traditional traders bash me on the head, let me explain. The trend is my friend until the end because it guides me in all my trading decisions. All stocks, unless it is no longer traded, are always moving in a trend, whether it is an uptrend, a downtrend, sideways trend, or consolidation. When a stock is on an uptrend, it guides me to buy or go long. When it is on a downtrend, it guides me to sell or go short. And when it is moving sideways or in consolidation, it guides me to stay in cash or go flat until a new clear trend emerges. John Murphy, in his book Technical Analysis of the Financial Market, stated that in addition to having three directions, a trend is usually broken down into 3 degrees, namely major trend, intermediate or secondary trend, and near-term trend. A major trend is anything over 6 months. If you notice, this is the PSEI. The major trend for the index is up. For the intermediate trend, lasting for 3 weeks to 3 months, the trend is also up. For the near-term trend, anything less than 2 weeks, the near-term trend of PSEI is down. Quite a bit of misunderstanding arises because of different traders' perceptions as to what is meant by a trend. To longer-term position traders, a few days to a few weeks price action might be insignificant. To a day trader, a 2 or 3 day advance might constitute a major uptrend. It's especially important then to understand the different degrees of trend and to make sure that all involved in a transaction are talking about the same ones. So next time we talk about a trend, it is good to specify the degree of trend we're talking about to avoid any misunderstanding. Do you still remember this from Module 1? In the previous discussion of trend, it was stated that prices move in a series of peaks and troughs, and the direction of those peaks and troughs determine the trend. Let us now give those peaks and troughs their appropriate names, and at the same time introduce the concepts of support and resistance. The troughs L1, L2, and L3 are called support. This is a level or area on the chart where buying interest is sufficiently strong to overcome selling pressure. The peaks H1, H2, H3, and H4 are called resistance. Resistance is the opposite of support and represents a price level or area where selling pressure overcomes buying pressure. In an uptrend, the resistance levels represent pauses in that uptrend and that are usually exceeded at some point. In a downtrend, the troughs L1, L2, L3, and L4 are called support. In a downtrend, support levels are not sufficient to stop the decline permanently, but are able to check it at least temporarily. The peaks H1, H2, and H3 are called resistance. In a downtrend, buying pressure is not able to overcome selling pressure. Once a resistance or a support level is broken, its role is reversed. If the price falls below a support level, that level will become resistance. If the price rises above a resistance level, it will often become support. As the price moves past a level of support or resistance, it is thought that supply and demand has shifted, causing the breach level to reverse its role. For a true reversal to occur, however, it is important that the price make a strong move through either the support or resistance. As you can see here, once the resistance is broken and there is a breakout, the price immediately goes up. When the price goes down and it goes into a breakdown, the broken resistance turns out to become support. A solid grasp of the concepts of support and resistance is necessary for full understanding of the concept of trend. For an uptrend to continue, each successive low must be higher than the one preceding it. Each rally high must be higher than the one before it. If the corrective dip in an uptrend comes all the way down to the previous low, it may be an early warning that the uptrend is ending, or at least moving from an uptrend to a sideways trend. Drawing trend lines. A trend line is always straight. The price should touch the trend line at least 3 times to confirm that the trend line is valid. If it only touches twice, it is only a tentative trend line and you cannot be sure that a trend actually exists. A trend line should not cross any of the wicks. If a trend line is broken, you will have to redraw the trend line. A trend line should be approximately 45 degrees. If a trend line is too steep, it is usually not sustainable. If a trend line is too flat, then it may be a weak trend and can be broken easily. The importance of the trend line is determined by the number of times the price touched the trend line, and also by the duration of the trend. A trend line with the price bounces off it 5 times is a lot more significant than one where the price only touches it 3 times. Similarly, a trend that lasts for 3 weeks is a lot more significant than one that lasts for 3 days. The more significant the trend is, the more reliable it is. You will be able to trade a trend with more confidence. Also, a break in a strong trend line will also be a lot more significant. An uptrend line acts as support, while a downtrend line acts as resistance. The most basic use of a trend line is to see where you can buy in an uptrend. As you can expect the price to come down and touch the line during corrections or retracement before going back up again. The line effectively provides a moving support for the price, and you can use this to improve your trading. In a downtrend, the opposite applies. The trend line is a resistance. The price will keep coming up to touch the trend line, and you may choose to go short when the price goes up to touch it on a retracement. Once again, it is a moving target that changes over time in line with the current trend, and you'll quickly see signs of any change in the trend. Trend lines can offer great insight, but if used improperly, they can also produce false signals. Other items such as horizontal support and resistance levels or peak and trough analysis should be employed to validate trend line breaks. While trend lines have become a very popular aspect of technical analysis, they are merely one tool for establishing, analyzing, and confirming a trend. Trend line should not be the final arbiter, but should serve merely as a warning that a change in trend may be imminent. By using trend line breaks for warnings, investors and traders can pay closer attention to other confirming signals for a potential change in trend. Okay, I hope you learned something today. Before you go, please subscribe to this channel so that you can get updated whenever I upload a video. Bye for now, take care, and I wish you the best in your learning journey, and good luck on all your trades.